What if the true origin of modern financial power did not begin with the banks you know, but with a single family operating centuries earlier, quietly shaping economies long before Wall Street or global institutions existed? And what if their methods, their networks, and their hidden architecture of influence still echo inside every financial crisis we face today? This is not the story taught in classrooms. It is the story buried beneath layers of official history, where the rise of the first Megabank was not an accident, but a deliberate construction built on information control, cross-border credit, and the kind of economic leverage that rulers feared but secretly depended on. Long before the age of multinational banks, this family understood something empires had not yet realized. Money moves faster than armies, and credit can conquer more territory than any navy. They built correspondent networks that crossed languages, borders, and political systems. They financed conflicts, stabilized collapsing kingdoms, and manipulated currency flows at a time when most governments barely understood the mechanics of monetary supply. Their power came not from titles or crowns, but from the one force every empire worshipped in silence: liquidity. But what made them truly dangerous was not their wealth. It was their ability to see patterns others ignored. They recognized that economic cycles repeated themselves. They saw that political promises were fragile. They understood that currencies rise and fall based on confidence, not morality. And while kings dreamed of permanence, this family built systems designed for volatility, systems that allowed them to profit whether empires expanded or crumbled. As we uncover how they operated, you will start to recognize disturbing similarities with the dynamics shaping today's global economy. The mechanisms of control, the quiet centralization of credit, the way influence hides behind institutions that appear independent, and the recurring illusion that collapse only happens to others. If the past feels uncomfortably familiar, that is because the architecture of financial power has not changed as much as we believe. Before we move deeper into their ascent and the machinery they engineered, tell me something in the comments. Have you ever noticed how financial crises seem to follow the same script? Leave your insight below, hit the like button, and check whether you are already subscribed to the channel so you do not miss the next layers of this story. What comes next may challenge everything you thought you knew about the origins of global banking, and it connects directly to where this narrative is about to take us. As their influence expanded, the world around them was undergoing a transformation that few understood at the time. Economic power was shifting, slowly but decisively, away from traditional rulers and toward those who controlled information and credit. This family recognized the subtle instability forming beneath the surface of global trade, watching as empires depended increasingly on intermediaries who could move capital across borders faster than any formal institution. They saw opportunity where others saw risk, stepping into the vacuum created by disconnected markets and fragmented political systems. Their ascent was not sudden. It was the result of precise positioning inside a world that still believed authority flowed from thrones rather than ledgers. With every transaction, they embedded themselves deeper into the machinery of states that believed they were using bankers to solve temporary problems, unaware that those bankers were slowly becoming indispensable. The turning point came when regional conflicts began draining treasuries faster than governments could replenish them. War was expensive, unpredictable, and often mismanaged. But debt was reliable. Debt created dependency, and dependency created influence. The family learned early that lending to rulers in desperate situations gave them leverage unmatched by landowners or military commanders. They were no longer simply merchants. They were stabilizers of regimes, arbiters of political survival, and quiet architects of economic policy. Their networks spanned territories divided by religion, language, and hostility, yet their credit was accepted everywhere because neutrality made them valuable. They served enemy states simultaneously, not out of ideology, but because every side needed liquidity and few understood how to manage it. This ability to play both ends without exposure allowed them to accumulate a form of power no monarch could openly acknowledge, yet none could afford to challenge. Each new connection extended their reach. They established partnerships in major trade hubs, inserted themselves into disputes between rival houses, and positioned their operations in regions where currency shortages or unstable governance created constant demand for skilled financiers. As their system grew, it resembled an early blueprint for modern global banking. Decentralized for protection, unified by shared strategy, and flexible enough to survive political upheaval. Their rise was not only the story of a family becoming wealthy, but of an emerging financial order taking shape beneath the official narrative of empire. And it is inside this evolving structure that the first mechanisms resembling modern banking begin to appear, mechanisms that would soon redefine the balance between states and those who finance them. As their presence expanded across regions, the family began shaping tools that looked strikingly similar to what we now recognize as the foundations of modern banking. These were not formal institutions with marble halls or official charters. They were discrete systems built to solve practical problems in a world where transporting physical currency was dangerous, slow, and easily disrupted by conflict. Their solution was a sophisticated network of credit instruments that allowed wealth to move without ever being physically transported. Merchants could deposit funds in one city and retrieve them in another through written instructions, trusted only because this family's signature carried more weight than the seals of many rulers. In an era defined by uncertainty, their reliability became a form of currency in itself. This innovation went beyond convenience. It quietly transferred power from states to those who controlled the ISIS flow of capital. A king could raise taxes, but taxes took time. Armies needed payment immediately. Supplies had to be secured instantly. And while treasuries struggled with delays, this family could shift resources overnight through their network. The result was subtle but transformative. Governments remained in command, yet their ability to act depended increasingly on private financiers who provided liquidity at critical moments. Every letter of credit, every transfer arranged across borders, strengthened the invisible infrastructure they were building. What made their system truly revolutionary was its adaptability. Where official institutions were rigid, their network flexed with political winds. When war erupted, they did not lose access, they expanded it. When a region faced collapse, they positioned themselves as indispensable intermediaries, capable of stabilizing trade when governments could not. Their agents became experts in assessing risk across diverse territories, evaluating the creditworthiness of nobles, merchants, and entire provinces. Through these assessments, they developed something modern economists consider fundamental, a consistent method of pricing trust. They also pioneered early forms of diversification. Rather than rely on a single territory or monarch, they spread operations across multiple centers, reducing exposure to any one political collapse. Each branch communicated through encrypted correspondence, forming a web of information, thicker and faster than the diplomatic channels of empires. This intelligence advantage allowed them to anticipate disruptions before they reached the public sphere. If a ruler appeared unstable, they tightened lending. If trade routes shifted, they redirected capital. Their network did not simply respond to economic currents, it predicted them. Over time, their methods became so effective that rival merchant families attempted to imitate them, but few could match the breadth of their connections or the precision of their internal structure. The mechanisms they perfected became templates for future banking houses, embedding the idea that true power in finance comes not from visible authority, but from the ability to orchestrate flows of money across borders with near frictionless control. And it is precisely this control that set the stage for the next phase of their influence, where finance would no longer just support political decisions, but quietly shape them from within. As their network matured, the family's influence over political and economic outcomes grew in ways few could fully comprehend. Rulers believed they were borrowing money to solve temporary crises, yet each loan subtly deepened the family's reach into matters of state. Currency shortages, regional conflicts, trade imbalances, and territorial disputes all created conditions where only those with access to mobile capital could intervene effectively. And while sovereigns publicly projected authority, it was often this quiet financial power that determined whether an army marched, whether a treaty held, or whether a kingdom survived another season of instability. In a world where coinage could be debased, treasuries looted, and economies fractured by war, the ability to stabilize value gave this family a form of leverage stronger than any battlefield victory. Their operations began influencing monetary decisions directly. When a ruler devalued his currency, the consequences rippled through markets controlled by the family, giving them the ability to reward or punish states through the simple act of adjusting credit availability. A king who paid promptly found his credit extended at favorable terms. A king who delayed or reneged discovered the painful reality of restricted liquidity. This softened the distinction between state authority and private finance. Decisions that should have been made in royal courts were now shaped by those who quietly controlled monetary flows behind the scenes. With every cycle of economic disruption, their role strengthened because governments consistently underestimated how fragile their own financial systems were compared to a decentralized network built to survive volatility. This influence deepened during periods of conflict. Wars consumed resources faster than governments could raise them, forcing rulers into dependency. The family financed both reconstruction and destruction, often simultaneously, because survival for them meant remaining indispensable, regardless of who won. Their neutrality was not moral, it was strategic. Providing credit to opposing sides ensured that victory never guaranteed independence from their influence. Once both parties were entangled, withdrawing the network's support could destabilize entire regions, giving them quiet veto power over political decisions. Their control also expanded through subtle manipulation of information. Access to trade data, currency fluctuations, supply, shortages, and diplomatic tensions allowed them to anticipate the outcomes of disputes long before they occurred. They knew when a monarchy was weakening, when a province was preparing to rebel, and when an alliance was about to fracture. With this advantage, they could position credit flows to shape events rather than simply react to them. Their archives became more accurate than government records, and their intelligence network more efficient than most royal courts. Over generations, their influence became so embedded in the geopolitical fabric that states could not easily distinguish their own financial stability from the stability provided by this private system. And with every dependency formed, the underlying pattern of how empires rise and fall became clearer to those who paid attention. If you have ever noticed how the illusion of sovereign power often masks deeper economic vulnerabilities, share your view in the comments, because understanding these hidden mechanisms is the key to grasping what unfolds next in this narrative. As their position solidified, the family began refining a model of influence that operated far beyond simple financial transactions. They understood that real power did not come from lending money, but from designing systems others were forced to depend on. Every partnership, every extension of credit, every rescue of a collapsing treasury was structured in a way that strengthened the central network while presenting itself as a benevolent service to the struggling states around them. What emerged was an early template for the invisible governance that characterizes modern financial institutions, a system where those who appear external to the political sphere quietly shape its outcomes through mechanisms that reproduce their authority with each crisis they resolve. Their alliances were equally strategic. Rather than align themselves permanently with any one kingdom, they worked with factions, dynasties, merchant guilds, and regional powers whose interests often conflicted. By cultivating relationships across rival camps, they created a structure resilient to political shifts. When a ruler fell, they already had ties to the successor. When borders were redrawn, their credit network adapted immediately. They did not gamble on stability. They thrived on fluidity. To them, uncertainty was not an obstacle, but a competitive advantage, because governments struggled during transitions, while their decentralized model gained strength whenever official institutions faltered. This strategy extended to their internal organization. Each branch operated with enough autonomy to withstand local failures, but remained tightly connected through shared protocols and a disciplined information flow. It resembled an early form of corporate governance, centuries before such terminology existed. Decisions were not dictated simply by opportunity, but by evaluating how each movement reinforced the network's long-term position. They avoided attention, preferring to let rulers believe they remained in control, while the family acted as the indispensable mechanism keeping economies functioning. And because they positioned themselves as problem solvers rather than power brokers, their influence often went unrecognized by the very institutions that relied on them most. Yet their methods were not limited to commerce or finance. They cultivated scholars, translators, diplomats, and advisors who could interpret political developments and cultural nuances long before news reached the general population. Their agents were embedded in trade caravans, court circles, and merchant ports, gathering intelligence that allowed them to anticipate disruptions with remarkable accuracy. While empires debated strategies based on outdated reports, the family adjusted its operations using real-time insight, redirecting capital, shifting credit exposure, and shaping expectations before official decisions were even announced. Through this expansion, their influence became a quiet force operating parallel to formal governance. They did not claim authority, yet they shaped policies. They did not command armies, yet their decisions determined which armies could march. They did not mint currency, yet their network often decided which currency retained value during periods of instability. It was a model of power so discreet that many contemporaries never fully realized they were living under its architecture, a model that now stood poised to face its first major fracture as internal pressures and external disruptions began testing the limits of even their carefully designed system. As the network expanded and matured, the first signs of structural tension began to emerge, not as dramatic failures, but as subtle imbalances that revealed how even the most sophisticated systems carry the seeds of their own vulnerability. The family had engineered a financial architecture capable of outmaneuvering states, absorbing disruptions, and surviving abrupt political shifts. Yet the very complexity that made it resilient also made it dependent on perfect coordination across vast distances. Branches began facing uneven conditions. Some regions prospered, generating reliable flows of credit and information, while others became entangled in conflicts, unpredictable rulers, or collapsing local markets. These inconsistencies forced the network to stretch itself in ways it had never been tested before. Compounding this pressure was the rising ambition of rival families, attempting to imitate or challenge their model. While none possessed comparable reach, their emergence disrupted the stability the family relied on. Competition for influence in critical trade hubs intensified. Courts that once welcomed their counsel began entertaining new financial partners, eager to prove their value by offering easier terms or aligning more visibly with political agendas. The family's greatest strength had been its neutrality, but neutrality required delicate balance, and balance became harder to maintain as geopolitical tensions sharpened across territories dependent on continuous credit. Internal dynamics added another layer of fragility. As generations passed, differing visions emerged about how aggressively the network should shape political outcomes. Older members argued for caution, emphasizing the importance of preserving the family's reputation as a stabilizing force above all else. Younger heirs, raised in an era where rulers increasingly relied on private finance, believed they should convert influence into more explicit power. These disagreements were not public, yet they subtly altered decision-making, slowing some responses and accelerating others, creating asymmetries that weakened the cohesion that had defined their earlier success. The external world was shifting as well. Several regions entered prolonged economic downturns triggered by crop failures, trade, blockades, and currency debasement initiated by rulers attempting to finance their expanding ambitions. Governments once considered stable grew erratic. Promises made in desperation were broken with ease, and the family found itself absorbing losses not because of poor calculation, but because the political order itself was becoming less predictable. Their intelligence network continued to offer early warnings, but even precise information could not fully shield them from the volatility emerging across interconnected markets. Despite these tensions, the network maintained its structure, yet with a growing awareness that the environment in which it had flourished was beginning to transform. The family no longer operated in a landscape of scattered risks it could strategically navigate. Instead, systemic pressures were forming, the kind capable of forcing even the most carefully engineered institutions to adapt or fracture. And it was within this shifting terrain that the early outlines of their eventual decline began to appear, traced not through dramatic events, but through the quiet accumulation of stresses that no system, however powerful, could ignore indefinitely. As pressures mounted across their network, the family faced a new reality that none of its founders could have fully anticipated. The world they had mastered was evolving into something more centralized, more bureaucratic, and increasingly shaped by state-controlled financial systems that threatened to erode the influence private networks had enjoyed for centuries. Rulers who once depended entirely on their liquidity began experimenting with early forms of state banks, institutions designed not only to manage revenue, but to reclaim the authority that had quietly shifted into private hands. These developments were still crude, often unstable, and prone to political misuse, yet they introduced a challenge unlike anything the family had encountered before. Their model of decentralized power worked best in fragmented systems, but the age of fragmentation was ending. At the same time, regional governments learned from decades of reliance. They observed how credit-shaped alliances, how currency shortages created pressure points, and how private financiers could influence outcomes far beyond what any sovereign considered acceptable. In response, some rulers sought to regain control by imposing new restrictions on interest rates, limiting cross-border lending, or tightening regulations on foreign merchants. Others attempted to build direct alliances with rival families in hopes of reducing dependence on the original network. These shifts were subtle at first, but collectively, they signaled a transition in global finance. States were no longer content to let influence operate in the shadows. Internally, the family was contending with another destabilizing factor. The generational divide that had begun as quiet disagreement now threatened the cohesion that once defined their operations. Younger members, shaped by a world where their ancestors' innovations had become the backbone of international commerce, questioned why they should continue operating behind the scenes. They argued that visibility could provide legitimacy, that open influence could secure advantages their predecessors had never pursued. Older leaders, wary of exposure, viewed such ambitions as dangerous provocations that could invite hostility from governments already anxious about private power. This tension weakened the unified strategy that had once allowed the network to act with unmatched precision. As these forces converged, early cracks formed between branches that historically operated in perfect synchrony. Some regions embraced calculated risk, expanding aggressively even as markets became more volatile. Others withdrew, prioritizing preservation over expansion. The result was a slow but perceptible divergence in strategic direction. The once seamless network began behaving less like a single organism and more like a set of competing visions, held together by legacy rather than alignment. And while none of these shifts immediately threatened their survival, they altered the network's internal rhythm in ways that made it less adaptable and far more vulnerable to external shocks. Yet the most profound shift was psychological. For the first time in generations, the family sensed that their dominance was no longer guaranteed. The patterns of economic cycles they once navigated with ease were evolving under the weight of emerging institutions, shifting alliances, and increasingly centralized forms of state power. Their influence remained significant, but it no longer felt invincible. And if you have ever noticed how even the strongest systems begin to change long before collapse becomes visible, share your insight in the comments, because understanding these transitions reveals what happens next in the evolution of global financial power. As the world shifted toward outmaneuvered, greater centralization and state authority hardened around monetary control. The family found itself navigating an environment no longer defined by fractured sovereignties, but by emerging national systems that sought to monopolize financial power. The introduction of standardized currencies, regulated credit channels, and the early frameworks of institutional banking began to erode the advantages that private networks had leveraged for centuries. Governments understood that the ability to command economic cycles required more than taxation or territorial dominion. It required controlling the instruments of liquidity that had once flowed privately through the family's hands. These developments reshaped the landscape, not by removing private influence entirely, but by forcing it into narrower corridors where the state increasingly dictated the terms. The family adapted, but adaptation came at a cost. Their decentralized structure, which had been an unmatched strength and volatile eras, now made it difficult to respond collectively to the rising institutional order. Some branches attempted to embed themselves within these new systems, forming partnerships that blurred the boundary between private networks and official banking. Others resisted, holding on to older methods that had once granted them unparalleled mobility. This divergence created internal friction that began to slow decision-making at a time when speed and cohesion were becoming essential. The family could still influence credit flows and stabilize markets, but they were no longer operating above the political structures they once navigated so effortlessly. State-backed institutions also began absorbing the functions the family had pioneered. Letters of credit, once their signature tool, were formalized into regulated instruments. Central treasuries adopted standardized accounting practices that mimicked the network's internal methods, even intelligence gathering, which the family had perfected. Through merchant routes and diplomatic circles, increasingly shifted into official bureaucratic systems designed to support national interests. What had once been their unique competitive edge was being replicated, often with the resources and authority only states could wield. Their innovations were becoming institutional norms, and with each adoption, the gap between their influence and that of emerging financial authorities narrowed. Compounding this challenge was the growing pressure of global integration. As trade routes expanded and empires sought more predictable economic environments, the tolerance for private networks operating outside state supervision diminished, regulations tightened, monopolies were granted to state-approved entities, and cross-border transactions faced greater scrutiny. The family's ability to maneuver discreetly weakened, as transparency became a tool for governments to assert dominance over the financial sphere. The discretion that had once enabled them to support rival states simultaneously became a liability in a world that increasingly viewed private influence as a threat to national stability. Despite these constraints, their legacy remained undeniable. The systems that were rising to prominence drew heavily from the architecture they had spent generations perfecting. Yet the irony was unmistakable. The very structures they created were becoming instruments of their displacement. Their expertise allowed them to survive longer than most contemporaries, but survival was no longer synonymous with supremacy. They were operating within an evolving order, one in which their foundational methods persisted even as their dominance waned, setting the stage for the next transformation in global finance and the shifting balance between private authority and public power. As the institutional world strengthened around them, the family's influence shifted from active dominance to something more subtle yet deeply embedded in the foundations of global finance. Their innovations had become so integrated into the economic systems of emerging nations that separating their legacy from the new order was nearly impossible. The early mechanisms of credit transfer, risk evaluation, and cross-border financial mobility they had pioneered now formed the structural language of modern banking. Even as their direct authority diminished, the frameworks they created continued to shape how governments issued debt, how merchants moved capital, and how states evaluated monetary stability. Their presence was no longer visible through overt control, but through the architecture that entire economies relied upon. This transformation mirrored the natural evolution of influence. Power, built on secrecy and fluidity, thrives in fragmented systems. But once states consolidate authority and expand bureaucratic reach, the role of private networks shifts from leadership to legacy. Yet in this shift lay a different kind of impact. The family's practices served as reference points for those constructing the first state-backed financial institutions. Central banks, emerging treasuries, and regulated credit offices borrowed heavily from the mechanisms that had allowed the family to operate across borders with unparalleled efficiency. Rather than erasing their influence, institutionalization preserved it in a new form, embedding their methods into the very systems that replaced them. Their historical reach extended beyond technique. The family had shown that information flow was as crucial as monetary flow, a principle modern economic authorities adopted with rigor. They had demonstrated that trust could be quantified, priced, and standardized, a concept later formalized into credit scoring and risk modeling. They had proven that liquidity, when managed strategically, could shift geopolitical outcomes as effectively as military power. And although their names slowly faded from public discourse, the patterns they established remained active in the decisions of governments navigating debt cycles, currency fluctuations, and the consequences of global interconnectedness. What persisted most strongly was the recognition that financial power operates independently of political cycles. States rise and fall, but the systems through which value circulates endure, shaping how future powers govern their economies. The family's network had once revealed the vulnerabilities of empires dependent on borrowed resources. Modern institutions now confronted the same truths, grappling with debt burdens, fragile currencies, and increasing reliance on credit systems remarkably similar to those the family had designed centuries earlier. This continuity underscored a deeper pattern. The tools may have changed, but the dynamics of influence, dependency, and economic leverage remained fundamentally the same. Their legacy, therefore, existed not in titles, monuments, or visible authority, but in the global financial infrastructure crafted upon their innovations. Every modern megabank, every central banking policy, every coordinated monetary response to crisis carried echoes of the methodology they refined. And as the world accelerated into an era defined by institutional control and geopolitical complexity, the traces of their design continued shaping decisions in ways few recognized but no system could fully escape, setting the stage for the final reflections on how their influence still reverberates in the financial order that surrounds us today. Across the centuries, the world moved on, yet the imprint of their system never disappeared. What emerged in their wake was not merely a new financial order, but a redefinition of how power functioned in an interconnected society. States now claimed authority over monetary policy, but the underlying mechanics mirrored the architecture the family had perfected. Debts became instruments of governance. Credit became a diplomatic tool. Markets responded more to invisible flows of capital than to declarations from thrones or parliaments. Even modern institutions, celebrated as innovations of the contemporary era, relied on principles the family had tested long before the existence of regulatory bodies or international oversight. Their influence had dissolved into the very structure of global finance, leaving behind a pattern that could be traced through every crisis, every expansion, every sudden collapse. As new financial giants rose, they inherited a world already shaped by centuries of experimentation. The lines between public authority and private leverage blurred, just as they had in the family's early operations. Central banks assumed roles once played by private networks, yet they too confronted the same vulnerabilities: dependence on confidence, exposure to cycles, and the constant need to adjust in a system that never fully stabilizes. The mechanisms designed to make economies predictable revealed themselves to be fragile whenever external pressures intensified. Patterns resurfaced, repeating the logic that had guided the first megabank. Influence belongs to those who understand the movement of money, not simply those who claim jurisdiction over it. In many ways, the family's decline was less an ending than a transition. Their disappearance from public view allowed their methods to become universal, no longer associated with a single lineage, but embedded in the global system itself. Even today, whenever government negotiates debt restructuring, whenever institutions coordinate to prevent currency collapse, or whenever credit networks quietly determine the direction of geopolitical strategy, echoes of their design can be seen. Their story becomes less about the rise and fall of one financial dynasty and more about the continuity of a logic that outlives the people who created it. A reminder that the world's most powerful systems rarely vanish. They adapt, migrate, and reemerge, in new forms disguised as progress. If you reach this point, you already sensed how these patterns still shape our world, and I want to hear your perspective. Leave a comment using the phrase, "I am here until the end," so I know you followed the full journey, and share what part of this hidden history struck you most. If the depth of this narrative helped you see modern finance through a different lens, consider subscribing so you stay connected as we explore the next layers of how power truly operates. And give this video a like to help this story reach more people who have never questioned where our financial world really came from. There is another video here that continues this path, revealing how these ancient structures evolved into the modern institutions that govern us today. Click it and keep walking through this history with me.